Good morning, friends, and a very warm welcome to our special webinar review of August 25 policy and brought to you by Bankers Weekly and Elite Bankers Club. We have very distinguished audience today, and as you know, the RBI released its latest monetary policy review a few days ago, and the decisions have significant implications for the Indian economy and most importantly for our banking sector, who will give a presentation on the current domestic and economic scenario because that is the context in which the policy decisions are taken by RBI. So first of all, we will start with Sundarajan sir, and I will request Sundarajan sir to start his presentation. Over to Sundarajan sir.
Good morning, friends. The RBI has come out with the monetary policy. As in the past, I am going to discuss about the economic condition, both then gross NPA at 2.24%. Last year, same time it was 2.67. Net NPA is at 0.53. Last year, same time it was 0.60. LCR is a comfortable position of 132.50%. And then ROA is also 1.34%. ROA is about 12.76%. Net interest margin is about 3.24%. It was in 3.54% in June 24. A slip of only 30 basis point it has happened. That way, and then credit deposit ratio for the banking system as a whole was 78.9%. Corporate bonds issued by the non-financial entities have increased to 0.95 lakh crore. In financial year 25-26, it was just 0.09 lakh crore. I mean, fantastic increase has taken place in the corporate bonds. Bank credit have recorded a growth of 9.8% during the current year. Last year it was 14%. It has come to 9.8%. That way, these are all the things that are happening. So we have to take care. I mean, if you analyze what are the reasons, etc., we have to look into it. Now, coming to the liquidity, system-wise liquidity is very comfortable. About 3 lakh crores is there. If we see the dynamics, how it has happened during the and a large favorable base effects combined with steady progress in the southwest monsoon, healthy kharif showing and adequate reservoir levels and comfortable buffer stock of food grains contributed to this moderation. And it may be beyond that also if there is unfavorable base effects and demand side factors from policy actions come into play. So it again, it concludes saying, barring any major negative shock to the input prices, core inflation is likely to remain moderately above 4% during the year. And then weather-related shocks, despite the US president describing India as a dead economy, reservoir levels as of 31st July is also at 69% of the full capacity, whereas corresponding period last year it was 46%. That way, on the supply side, also the things are good. Service activity remains steady. Some frequency indicators recorded a modest expansion. E-way bills have increased by 19.3% in June. Growth of the gross GST collection moderated to 6.9% in June-July 25 after 16.4% growth in May. Domestic air cargo traffic posted a growth of 2.6% in June 25. Port cargo 5.6% in Q1 of 25-26. Sale of commercial vehicles, growth in the industrial sectors remains subdued, uneven across different segments. If you see, steel consumption grew by 7.9% in Q1 of 25-26, cement by 8.4%. Again, it talks about this one. Bankers, here is a lesson for us. Between 2015 and 2025, outstanding bank credit to large industries rose from 21.4 lakh crore to 27.3 lakh crore, a compounded annual growth rate of 3.9%.
So, dear friends, it's a great pleasure to be associated with this webinar. and with the background of the discussion that Sundarajan sir has already made, now we will be moving on to the key policy measures directly. As we know, all of us, that repo rate has remained unchanged as expected by the markets, could be controlled. So as a result of the repo rate remaining at 5.5, the standing deposit facility will remain at 5.25, marginal standing facility at 5.75, and the CRR, which has been reduced by 1%, its impact will now start coming, and the policy stance continues to be neutral, which are already repriced. So now next is system liquidity. The WACR, that is weighted average call rate, is ruling below the repo rate, but within the corridor of the repo rate and SDF rate. Robust banks are doing very well. I think last quarter also we were doing very well, and of course there are certain signs of stress. Banks wanted to keep with them so that they don't default, and it's always good to have good liquidity, but then the liquidity works for the bank if it is deputed in the, if it is deployed in the markets. Otherwise it remains underutilized. That is one risk of having more LCR than the LCR which is desired, or they are opting to keep it with RBI by participating in the auctions of VRR, which is conducted by RBI. VRRR has already been stopped by RBI after the June 6th policy. So that is what I was telling, that little stress is building up now. And NBFCs are equally doing good. Their capital adequacy ratio is 25.78, built between the banks and the NBFCs moving forward. NBFC's GNPA, that is NPAs, are lesser than our banking system. It is 2.47% against 2.67%. That means NBFCs are doing better in terms of maintaining the asset quality, and the your net NPA is down to 0.95%. Now, as far as the credit growth is concerned, I think a lot has been talked by Sundarajan sir. But nevertheless, when the measures are talked, we will have to talk about the credit growth, which grew at 12.1%. There will not be much of disruption as far as the trajectory of growth of GDP is concerned. That means funds are going into the industry and they are working their way to generate the kind of goods and services which will add to the GDP of the country. So as of now, there is not much of and the overall forex reserves are about 689 billion. That is about 11 months import needs are met by that. Can be expected sometime in December and February in the coming times. And then I think that will be the saturation point as far as ability to cut the rates are concerned. And then the cycle of interest rate cuts, interest rate rises, all these things will keep on going on, unless some new should be the credit growth. So that takes us to 6.5 plus 6, 12, 15%. 15% GDP credit growth because the Jan Dhan accounts have completed 10 years and the renewal of KYC is required. I think this completes as far as the measures and its implications are concerned. And now I would request our Kalia sir, the eminent speaker and very what you call expert as far as the financial sector is concerned. And Arvind ji, I think you want to pass it on the baton to him.
All the participants for making it convenient to attend today's webinar. And I think Dr. Rao has shared all the policy measures taken, as also not only the policy rate has been kept unchanged, the stance has been also kept unchanged. So that is one particular, these measures are announced where there is absolutely no change. So what has contributed to such significant drop in CPI inflation is primarily deceleration in food inflation. In fact, there is a deflation. And Q3 it is 3.1%, Q4 4.4%, and Q1 of 26-27 it is 4.9%. Now coming to GDP, people were believing that there would be some kind of, a 50% tariffs that have been announced by US on our exports effective from 27th of August. Now, certain things that were made out, which I would like to highlight is that it is believed that even after 100 basis points reduction in repo rate since February 2025, mortgage growth is down to 9.6% on a YOY basis from 18.2%. I am talking in the context of the banking system. From 17.3 to 9.3% non-food bank credit. So, what is the constraint? Constraint is that there is some kind of cautious approach towards certain, customer profiles like self-employed and high-risk borrowers. And, there is also a shift that is taking place from non-bank sources are going up. What is required to be done? As is being mentioned, is it going to be, if all those who have been tracking the financial results of the banks would have observed that NIM of all banks, practically speaking, has gone down in Q1. After every 4 weeks, there would be a reduction of 25 basis points till November. So that is going to release some 2.5 lakh crores. Banking sector, there is a impact on credit growth. They will have to work out strategies as to how they are able to. But if to which corporates can do, that is money market instrument, bonds, etc. So these are the segments where I think banks would be focusing more and more, and they will have to improve. Impact on NIM would be there, but this will be much better in second half. This quarter is going to be another challenging quarter. In his policy statement where he says about agriculture, because of the steady southwest monsoon supporting kharif sowing. Kharif sowing, in fact, significantly by 5.1% as compared to last year, by that within that period. And this would definitely, this kind of, information or data point that has been shared gives us an impression that agriculture sector would continue to do well, and agriculture activity will definitely get a boost because of these particular developments that have been shared. Services sector is continuously doing very well. It has been very steady. It has been growing. Services PMI, GDP, it has come down to 0.6% now. And it is primarily because of service sector exports growth that has taken place. Because so far as mercantile trade is concerned, that deficit is going up. But despite that, if we are in a position to contain our current account deficit, it goes to the service sector exports, which have done exceedingly well. Particularly, as he was mentioning, electricity and mining has contributed or impacted IIP numbers negatively, has contracted by 1.9% during first quarter. So industrial sectors per se are, I would say, growth is subdued, uneven across segments, is not even growth that is taking place. Some sectors are doing well, which I have mentioned, but others are showing, negative contraction. So that is little bit of, worrying sign. But overall, it is resilient. The domestic economy is resilient, but global factors would play a very, very important role with this uncertain geopolitical environment in which we are all living. Particularly, this has been heightened by President Donald Trump because of, all kind of announcements that he keep on making and making the entire, global scenario little uncertain. So far as external sector is concerned, I think we are very, very comfortable with our foreign exchange reserves, 688.9 billion of reserves, which takes care of my 11 months of mercantile imports. But if we look at the outstanding loan portfolio, the reduction is only 39 basis points. So a lot of ground is yet to be covered in order to have effective transmission of policy repo rate cuts and weighted average deposit term deposit rate. Growth inflation dynamics is one on which, and that is going to be, those decisions are going to be primarily data dependent and data driven. What kind of data unfolds going forward? On the basis of that, this, whether there would be a downward revision in GDP forecast numbers, whether there would be opportunities to further policy rate cuts, some kind of, elbow room available with the Reserve Bank of India to at least effect one policy rate cut of 25 basis points. But that decision would be taken only when they look at as to how is the growth momentum continuing in Indian economy. Global uncertainties are going to play out on the Indian economy.
Thank you, Kalia sir, for explaining the whole thing very beautifully. I don't see the name actually. It is written iPhone only. You had raised a hand also. So please go ahead. You can ask your question.
I'm not able to understand the import of the question. How is it?
Previously, it
yes.
used to be backed by fully initial years, gold standard, etc., etc. From there, we
Yes.
moved. So it is always better to stock in the form of a thing, gold. So they kept it as a thing, as a strategical
Strategic decision.
investment decision.
I
Yeah.
think we have come to the end of today's session. And to all our attendees, I thank you for your active participation. And I hope this session has been valuable to you.